Hello, welcome back. Well, welcome back if you're a previous listener. If you're a new listener, we're glad to have you just the same. This is Wade into Wealth. I'm Chuck Wade. My brother Ethan is here too.
I am.
Fancy a story?
What?
Fancy a story?
Are you asking me to tell a story?
Well, I'm going to tell it, but I'm asking you if you'd like to hear it.
Yeah, well, yes.
Okay.
I thought you were putting me on the spot to tell a story.
No.
Got
I'll
nothing
tell you a
prepared.
story. Gather around, child, and I'll tell you the tale.
Okay.
It has to do with what we're going to talk about today.
Of course it does.
I don't think I've ever told you this because there was never a reason to.
Okay.
But today I think it works. So I was a junior in college at Brockport, go Golden Eagles, and I'd been nominated. I was in their broadcasting program. I'd done a story. It was nominated for some award, best reporting. Okay. So the awards conference was in San Diego. So mom and dad footed the bill for me to fly out to San Diego and go to this conference, thinking, hey, maybe I'd won the award. I don't know. I didn't win the award. Okay. So I just got a day out in San Diego. On the flight back, now I'm in college, junior, so like 20 years old.
Yep.
Okay. Start talking to this guy on the flight back to Rochester. And he was probably in like his mid-50s or so, and he had just started a second career in investments. So we got talking, and I thought, this kind of sounds like maybe something I should be doing. Sounds like something that would be smart, there'd be a benefit to. So we have this conversation, and I said, maybe give me a call. I'd be interested to learn how I can start, because this sounds like something I should be doing. So the guy called a week later. I'd forgotten about it. He called and told me that he had a bond he thought would be a good fit for me, and for $10,000, I could buy the bond. Now, I was 20 and in college. I did not have I probably didn't have $100, let alone $10,000 to buy a bond. Second, completely inappropriate investment probably for someone who's 20 years old and in college.
I think so.
I think what might have been more helpful is, hey, maybe you could consider starting an IRA or a Roth IRA, or here's an investment account, and you could put $50 a month into it. Calling a 20-year-old to say, I've got this bond that for $10,000, you can invest in it, and it'll pay you some percentage.
Must have been a heck of a bond.
I don't know. Needless to say, I was like, I think I said, I'll call you back, and just never called him back. But needless to say,
no bond for you.
I did not buy that bond.
Nope.
It was $9,990 short of being able to afford it at the time.
That's all right.
But we're going to talk about bonds today because there are people for whom they're quite appropriate. And
yeah, there's a lot of people who they are.
Yeah.
And so we should first start with, what are they?
Thank you.
Yes. A bond is a contractual obligation that a company has. So let's use an analogy. You're going to buy a house, and you go to the bank, and you let them know the house is whatever, $200,000. And the bank says, we will lend you the money. You will pay us this rate of interest, and over time, you'll pay us the principal back. And eventually, you'll have it fully paid off. At that time, you won't owe any interest, and you won't owe us any more money. The house is yours, outright, free and clear. In the scenario of a bond, the investor is the bank in the analogy of the mortgage. And the investor lends money to either a corporation or a municipality. There's two types of bonds most widely known. A corporate bond, which is a for-profit company like a General Mills, Procter & Gamble, Amazon, Google, technically Alphabet. They will have bonds out there. Those are considered debt to them. Or what's called a municipal, which is tied to your state. And it's typically a government-run entity in some capacity. Monroe County has bonds out there. Those are called municipal bonds. New York State Thruway has Thruway bonds out there to help pay for repairing potholes, and they have tolls that help them pay the debt off for them. Municipal bonds are a whole other conversation with how the taxes work on that, but we'll hear those types of names. And a bond in its simplest form is just a contract. And that company has a contract with the investor to pay them an annual interest rate, and there's a maturity date for which they will give the principal back to the investor.
A contract, a loan is another way I like to think of it. It's a loan. You are giving the company money. they are going to pay you interest, and they will pay you the face value of the bond back upon
Maturity.
maturity.
Yep.
Okay. Why would someone own one?
They tend to carry less risk than stocks.
Okay.
A couple of reasons. One, a bond can help be a buffer during volatile times in the stock market. And two, to earn interest. For income-seeking investors, bonds are a good way to be able to generate interest without having to take the amount of risk that you would in the stock market.
So your upside is limited. You know what
Yes.
you're going to make, but you won't make more than that. It's not typically, you're not investing in a bond to see it go up 20%.
No, we often refer to bonds as what's called fixed income.
Okay.
They're called fixed because pretty much you know the return that you're going to get off of it before you get off of it.
Yep.
Before you even
Yep.
make
Let's
the
just
investment.
move on from it. Yep. We'll talk about that later. Yes. Bonds. I liken the bonds to the basement in a house often, in that basements typically are not exciting. But
I don't know. Your basement's pretty exciting.
well, basements can be exciting in that ours was finished, but in that you want it to be a good, solid foundation.
Yes.
And you don't want there to be cracks. Your basement isn't something you're taking risks, and it's rarely the part of the home that you bring someone to when you want to show them and say, hey, look at this basement, look at these cinder blocks. But you want it to be solid, and you don't want to have to worry about it. And so bonds are the kinds of investments that you know what you're going to get. You're going to earn a stated rate of interest for a period of time, and then when the bond matures, you get the face value of the bond back. What is face value? Let's talk about that, because I've mentioned that twice now and think we should talk about what it is.
Typically, it's $1,000 per bond. So face value would be the amount that the organization has to pay back. But in its simplest form, and maybe there are some that are different. If they are, they're few and far between. One bond equals $1,000
Right.
of face value. So if you invest, we're going to use an analogy, $1,000 into, let's say, an AT&T bond, and they're going to pay you 3% interest for 3 years, and on September 27th of 2025, they'll give you your $1,000 back. That's the face value of the investment.
And they will have paid you interest along the way.
Correct, that 3% annual
Right.
interest rate.
That face value doesn't necessarily mean you're going to pay $1,000 to buy a bond, though.
Nope, it can be
It can change.
more than that. It can be less than that, and it's all a factor of what's going on with interest rates in the economic environment.
So for the longest time, I would say really prior to the past 9 months, bonds were not the best investment for a lot of folks. And the reason for that was, or it was not the most desirable investment, I should say, or optimal, because of the fact that with interest rates as low as they were, bonds that were of good quality, $1,000 face value bond, you might have had to pay $1,200 or $1,300 to get it. And you'd get an interest rate, but then at the end, you'd get $1,000 back per each of those bonds. So when we'd factor in the interest you received, but the face value that you received back, knowing you paid a little more than that at original investment, we were finding that the actual yields on these bonds were fairly low.
Yes, and that's also a factor of how low interest rates were.
Right.
Interest rates have come up a lot this year, but I think it's important when we talk about bonds, we often look at them as an investment that has modest risks. And when compared to stocks, they do. But compared to your bank savings account, they do have more risk than your savings account. And there's really two types of risks with bonds. There's what's called interest rate risk, which is what you were just referencing to a degree. And then there's what's called credit risk. Credit risk deals with the company that you're investing in or that you're lending money to. So there's two types, and there's ranges within these types. There's what's called investment grade bonds, and there's what's called junk bonds. I mean, we're not picking on them. The broader financial markets call them junk bonds, speculative types of companies. Those are companies where there's concern about their financial health.
The quality of the companies.
Correct. So every company, similar to if you go to the bank to get a mortgage or some sort of loan, they're going to pay attention to your credit score.
Mm-hmm.
And every investment in the bond market has a rating with it, which is the equivalent of their credit score. And that investment's credit score dictates, do you have to pay more interest or do you have to pay less interest?
Right.
Because we have to remember, we've talked about this in podcasts before, you're compensated for the level of risk that you take. And so stocks over a longer term time horizon, the S&P 500 since its inception, has averaged north of 10% per year.
Mm-hmm.
You're unlikely to find bonds that are of quality that are going to pay you 10% interest per year in the current environment that we're in. You're going to find bonds that'll pay you 2, 3, 4%.
Mm-hmm.
Much less, but they're also going to have much less risk. So if we come back to what credit risk is, a company like a Procter & Gamble has less risk because of the stability of their business as opposed to a marijuana company who's new.
Right.
They're, it's being legalized in some capacities throughout our nation, but those don't have 60 or decades of a proven track record to say that they're going to be okay to honor their debt. So a company like Procter & Gamble is going to carry less risk and therefore what's called less credit risk. You have less of a concern that business will go under and that they won't be able to meet their obligations.
So the higher the quality of the company, the lower the interest will likely be that they would pay.
Correct.
Because you are receiving more stability by investing in that company than by investing in a company that is very small or that may operate in a very niche area or that is new or that has a lot of other liabilities. So think higher quality, lower return, but less risk.
Yes.
Because the biggest risk is that what happens if this company goes into bankruptcy?
Right, because they have to pay, because it's a contract, the company has to pay their interest and principal back as long as they're not in bankruptcy.
Right.
And so it all works fine unless the company goes into bankruptcy.
That's the biggest. That is what I would say is the biggest risk with any bonds.
I would agree.
With any bond is that if the company goes into bankruptcy and it then has to go to a bankruptcy court, and often one of the negotiations that takes place is what are bondholders of this company or how are they to be compensated? Very rarely do you get the face value back in that case and the interest you're due. You may get 70 cents, you may get 60 cents on the dollar, you may get a smaller portion, but that is the largest risk, is that the company goes into bankruptcy. How do you combat that? One is obvious, is own quality companies that you can be sure or be very confident in their ability to be around for the period of time in which you're going to own the bond.
Well, I think that's the most important part of it. Have quality, but also we would say, and this is kind of a jargon term, don't reach for yield. Meaning, don't try to get investments that are going to pay you interest of 7 or 8% when your quality types of companies are going to pay you 3 or 4% for 2 or 3 years at this point. Furthermore, though, is to have the bond be shorter term, because anything happens over a long-term time horizon. In the 1990s, Kodak was considered one of the best companies around.
Yeah.
Fast forward, however, 20 years or so later, they've gone into bankruptcy. And so if you want to reduce your risk with a bond, not only have a good quality company, but have the maturity set up to come due in the next 2, 3, 4, or 5 years.
How long can a bond maturity be?
Maybe as long as 30 years. They can probably maybe go a little bit longer than that, but I think 30 years is probably the longest that I've seen. Yeah.
They vary. You can buy a bond that matures in 3 months.
Yep.
You can buy a bond that matures in 30 years.
Yep.
The longer the maturity, the greater the risk, because the reality is there was a time I was spending a ton of money at Blockbuster Video.
Yep. Be kind, rewind.
Indeed. Solid company at the time. It no longer exists. There's one Blockbuster Video in Bend, Oregon. There's one. That's it. So look, I think there's a lot of really good solid companies. I'm not interested in buying a 10-year bond of any of them.
No,
because it's a long time.
Yep, and you take the risk that something could go wrong with that business in that time. So we spend a lot of time talking about what's called credit risk, the overall quality of the investment that you're lending your money to.
That's the first risk.
That's the first one. The other one that is very pertinent to right now and what's going on in the marketplace is what's called interest rate risk. Interest rate risk is the risk of, or the impact that interest rates have on the value of fixed income investments.
Ooh.
And they're negatively correlated, which means when interest rates go up, the value of fixed income falls.
Think of the teeter-totter on the playground.
That's right. I did a bad example of that.
Well,
they were at
and
the
some
same
people
level.
may not be watching.
Right.
So as interest rates rise, as one side of the teeter-totter goes up, the other side is going to go down. As interest rates rise, the price falls. The simple reason for that is...
And the reverse of that is true.
Right.
Interest rates fall, the value
price
of bonds
of the
will
bonds
go up.
goes up. If you, the dear listener, wants to buy a bond, and I have a bond that is paying 2.5% interest, that I said, hey, I'll sell it. And you, Ethan, have a bond that pays 5% interest, and you're saying, hey, hold on, I'll sell you mine too. Well, whose bond is more valuable to the person who wants to make the purchase? Mine, that'll pay you 2.5%, or yours, that'll pay 5%?
Mine, that pays 5%. But that's operating under the assumption that the quality of our bonds are like and similar.
It's a very simplified example,
It is,
but to
yeah.
illustrate why there would be that relationship between interest rates and the price at ProPro.
Because one of the big reasons you want bonds is to generate interest.
Correct.
And so why is that important now? Well, it's very important now because interest rates have come up so much this year.
Mm-hmm.
And a lot of clients who may own bonds, or you, dear listener, who maybe own bond funds in your 401k or your 403b or your 457 plan, what we perceive to be a conservative investment and kind of the buffer for us, because interest rates have been rising. And remember, when interest rates rise, the value of your bonds fall. We may look at that and think, this isn't as conservative as I thought it was.
Mm-hmm.
And right.
It's not.
It's in today's environment with interest rates rising, with the Federal Reserve continuing to raise rates, the investments that we thought were conservative are showing to have more risk than sometimes we may have otherwise thought. And that can be a very unnerving feeling.
It can. So let's pause for a second and state that we are now going to go into the difference between individual bonds and mutual funds.
Bond mutual funds.
Of bonds, because they are very different. When you think of stocks and the stock market, individual stocks, stock mutual funds, they tend to move in the same direction, in that if the stock market is going up as a whole, most stocks are typically going to go up. So they operate in concert. You can expect, if you own individual stocks or mutual funds in a bull market, they are likely to go up. They tend to operate relatively similarly. Individual bonds, bond mutual funds, there's a big difference. And what we're going to explain is how I actually have met with clients and said, I actually see in your 401k right now more risk in the bond mutual funds than in the stock mutual funds that you have. And typically when you say that, the answer is, really?
I'm not sure if they have more, but they have...
Well, let's say more than they think.
Yes, correct. That I think is accurate. And bond funds and bonds will move in the same direction. The value will. But there's one very key difference, which is the maturity date, which we talked about earlier.
Mm-hmm.
The individual bonds within the bond fund have maturity dates. But if you're an investor with a bond mutual fund, that fund in and of itself does not have a maturity date with it.
It can't.
Correct, because it just goes on in perpetuity.
Because it's got hundreds of individual bonds that all have different maturities in it.
Yes.
So it doesn't have just one maturity date.
Right, which in a rising interest rate environment, we would prefer to have a maturity date. The reason is, we talked about that as interest rates rise, the value of your bonds will fall. It's true for individual bonds. It's also true for bond mutual funds or bond ETFs. Same thing. Think of them interchangeably for the purpose of this example. They will go down in value, but with your individual bond, as that gets closer to its maturity date, remember, that is the date where you get the face value of the investment back. Your principal of the investment gets deposited back into your account. As the bond gets closer to that, you will naturally see the value of the investment creep higher back towards that amount. And so one strategy with an individual bond is to hold it to maturity date. Hold it to its maturity date. Because if you do that, you will drastically and significantly reduce the risk of interest rates.
I would say that is our preferred method.
It is our
with
preferred
owning
method,
bonds.
yes.
And the reason is that the price or value of any bond is listed as if you were going to sell it today on your statement.
Yep.
You might see. So we have a lot of folks that have bonds that show a loss right now if they were to sell them. And the reason for that is that the value that is being provided is, hey, if you were to sell this today, here is what you could expect to get from it. And in many cases, there are bonds that are trading for less than their face value.
Yep.
In which you might say, well, this bond is showing, if I have $10,000 in this bond, why does it only show it's worth $9,500? I thought
that's if you sell it today.
That's if you sell it today. However, if you hold it for another year and a half, you get the $10,000 back
on its maturity date.
Its maturity date.
Right.
So the interest rate risk is significantly less with individual bonds as long as you are planning to hold them until they mature.
Correct.
And
that does not exist with bond mutual funds.
It doesn't. And that is why there is more risk than people often believe with fixed income and bond mutual funds, because there is no individual maturity date.
And look, no one's really cared about it for the past couple decades, because all interest rates have done is just come down.
Right.
So it's never been a problem, because remember, if interest rates are coming down, the value of your bonds are going up.
Right.
So that it's never been a concern until now, when we've seen interest rates go up more than 100% so far this year. That's a meaningful jump. And now we all see that in our fixed income investments. And what we perceive to be this conservative investment. Look, it is still, in a lot of ways, more conservative than the stock funds. But what's your definition of that? Did you get into this bond fund thinking in 2022, when the markets are down close to 25%, that my bond fund will be down 10, maybe 15%? Maybe not. You might have gotten into it with the idea of that maybe it'll go down 2, maybe it'll go down 3, maybe it'll go down 5. But to see it down more than half of what the stock market is, that can be anxiety provoking. That can be nerve wracking.
I apologize. I cut you off.
Oh, no problem.
What has to happen for the price of these bond mutual funds or individual bonds to go back up?
Interest rates have to come back down.
That seems unlikely at the moment.
I agree.
And I say that not because I'm trying to make a guess, but just taking what the Federal Reserve has told us, in that they anticipate interest rates continuing to rise.
And why is that? Because their goal is to help get inflation under control. And the only method that controls prices is the supply and demand curve. And the Federal Reserve has no control over the supply curve.
No.
They can only control demand. Our goal of going to buy a new house, getting a new car, taking out a home equity line of credit, they can only work to dampen our demand or have us stop buying things by increasing interest rates. And it's a blunt object that they have. So if inflation isn't coming under control in the way that they want it to be, the only choice that they have is to continue increasing interest rates, which is going to have an impact on your bonds and on your fixed income investments.
It is, and it is having that impact.
Right.
Before we leave, are there opportunities right now?
Yes.
Let's talk more about that, because we've talked about what bonds are, the benefit, the risks, how some of them operate differently. But in any scenario, there are always opportunities. And we have seen some opportunities that have not really been there, especially for investors looking for conservative investments that will provide them with a higher level of income.
Yep.
Care to expand?
Short-term bonds. Short-term individual bonds. This is not a recommendation for any one of these, but to give you some perspective. To get just 2% in a short-term investment-grade bond back in December of 2021, we'd have to go out, 8, 9, 10 years on the maturity scale?
Very long. So you're saying we would have to invest the money for a period of 8 or 9 years to
To get
earn
2%
a return
per
of
year.
2%. Right now, you can.
I put it together yesterday for 2 years with companies like Home Depot, General Mills, American Express.
Yep.
And you got that person is getting more than 4% per year in
Yep.
interest, and those maturities are coming due in the next couple of years.
So what that means is the money is invested for a period of 2 to 3 years.
Yep.
And the return on that is anywhere from 4 to 5%.
As long as the companies stay in business. But again, we look at, do we think Home Depot 3 years from now is still in business? Probably. Seems likely.
Mm-hmm.
General Mills, Yoplait Yogurt, Wheaties, Cheerios, Blue Buffalo, Annie's Organic. Do we think they're still in business in 3 years? Seems likely.
Likely, okay. So there are opportunities. The other area where, and I had this conversation with a client the other day, they are not retired, they are not taking income, but they have cash and they would like to invest it. There are 3-4-year bonds from quality companies. You can buy a 3-year bond from Coca-Cola that right now is trading for 89 cents on the dollar. Now, it's only paying like 1% interest.
The coupon, yeah.
Its interest is low.
Yep.
It's only 1%. But the point of this being, the client does not need the income right now. They will plan to be taking it within 5 years. But for now, so the point of that was, we said, well, look at these bonds. If you invest in this bond from Coca-Cola, you put 89 cents in 3.5 years, you'll get $1.
As long as they're still in business.
In hard dollar terms, as long as Coca-Cola is okay, your cost to invest in $10,000 worth of this bond is $8,900.
Yep.
You're only going to get 1% interest. So you're going to get like $100 a year in interest. When that bond matures, though, you will get a full dollar when you paid 89 cents. So there are different strategies that can be used to take advantage of bonds having higher yields. That bond, there's nothing wrong with it. It just pays a lot less in terms of its income so that it's less desirable, which is why the price is down.
Yep. That's right.
So there are opportunities.
And it's important that all of the bonds that we talked about were merely examples for this conversation, but a lot of the numbers behind them are stuff that we have seen in the past couple of days.
Yeah.
None of it should be taken as a recommendation for you to do that. Always talk to your investment professional or your financial professional before acting on any of our advice.
Yes. These are.
And remember, we can also serve in that role for you.
Yes. We have the ability to do so.
We do.
But yes, this is not advice. These conversations we've had are also with people that we know their situations in great detail and have worked with them for several years and have made these recommendations with respect to their personal situations.
Yes.
That we're aware of. But they're out there, and I think it's important that we have this conversation about bonds.
Mm-hmm.
All right. Well, this has been an enjoyable afternoon spent with you recording this.
Likewise.
Thank you very little.
Mm-hmm.
Wade into Wealth returns next week.